Good afternoon, ladies and gentlemen. We're about to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, a staff member here with the OIC, and I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's session, covered combinations helping the disciplined investor. We'll take a look at covered combinations, which are a covered call as well as a short put, all on the same underlying. This strategy is useful for the investor who not only has a neutral to bullish outlook, but who is also open to the idea of owning additional shares of the underlying should the market pull back. As always, we'll go through today's material in a quick 60-minute session. Our presenter today is a senior specialist with OIC's Investor Services team, Mr. Darren Tate. Darren, a certified instructor for the Option Industry Council, has created many of the seminars and learning aids available on optionseducation.org that so many of you use today. Prior to his work with OIC, Darren played many roles at Fidelity Investments, and he earned his MBA in Financial Services Management from the University of Dallas. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you can submit questions at any point during the presentation. Darren will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you, and investors like you, with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. And now, ladies and gentlemen, Darren Tate will bring you our topic today, covered combinations helping the disciplined investor. Darren?
Yes, thank you, Nick. Appreciate the kind introduction. Very happy to be here this wonderful June afternoon. Maybe especially so happy because, according to my vendor here, the U.S. equity markets closed at all-time highs today, so everybody's always in a little bit better mood. This is my first live webinar. I've done several live seminars, and back 6 or 7 years ago when we were in a bear market, it was always kind of a subdued audience and not too excited to be there for the most part, so I've always found that these are much more enjoyable when the markets tend to be in a rally mode and everybody tends to be in a better mood. So that's a good thing. We've got a great topic for you here today, the covered combination. And maybe more importantly, we're going to be talking about how it can help a disciplined investor. I think investor discipline is something that is very important, and we're going to discuss that throughout this presentation in different ways that you can use this covered combination to maybe help you implement some investment ideas that you might have, and again, and more importantly, to help you remain disciplined in your investment outlook and in your strategies for your portfolio. We do always have to have our disclaimer slide. The characteristics document is found on optionseducation.org at the very bottom of the page. It's an important document that can answer many options-related questions. Also, in our presentation here today, we're not going to include commissions and fees and taxes. All these sorts of things vary not only by investor but by brokerage firm, and they're all going to have a different impact, but they certainly will impact the returns associated with any investment. So always check with your broker on what their fee structure is and understand the risks associated with that. And our examples are just based on hypothetical scenarios. We've tried our best to build real-world type of prices into them, but they are just hypothetical and just theoretical in nature. So we do get a lot of questions about exactly who is OIC, what does OIC do, and we always have to explain to investors that we're here to provide information on options. We try to present as best we can both the risks and the rewards of any investment, but specifically as it pertains mostly to options. We are funded at OIC by the 12 U.S. options exchanges. You see a list of them there. A lot of people think there's only one or two options exchanges when in fact there's multiple options exchanges. Not all options trade on every exchange, but a lot of them do, and there are 12 of them out there. OIC is also funded by OCC. I actually work for OCC, and much like options, something OCC takes very dear to the heart is managing risk. Options are about managing risk, and that is something that OCC takes very seriously. Also important to understand OCC's role a little bit very briefly is OCC holds all of the open interest. OCC does not make markets in options. OCC is not an options exchange. We get buyer and seller information from the exchanges, and we make sure the buyers pay their money and the sellers receive their money, and we verify that the terms of that option contract are going to be upheld. I always like this slide here because this slide gives us some idea about the growth that we've experienced in the last 41 years in the options markets. You really start to see some tremendous growth there in the last 15 or 20 years. And we here at OIC like to attribute a lot of that because of what we present. We help investors better understand options. It used to be, if you rewind the clock 10, 15 or so years, that a lot of investors would say, you know what, options are too risky. Well, maybe they are too risky, but at the same time, I think a lot of that idea that they were too risky is a lack of understanding. So it's important to understand what options are and how they work, and then maybe there's not a place for them in your portfolio, but at the same time, at least you have that out there in case it's an opportunity that you feel you might want to take advantage of. You'll note that the red lines there, I don't think there's a notation on the graph here, but the red line on those bars, the red portion of those bars, those represent index volume, index options volume, but the blue lines are stock and ETF options volume, both of which you can see the tremendous growth in. So all that being said, again, I appreciate everybody being here today. So let's get into the topic today on covered combinations. Here's a little bit of what we're going to talk about. We're going to go over covered combinations initially and talk about what it is, sort of how it works, some of the mechanics behind it. But because a covered combination consists of both covered calls and short puts, we're going to go into details on those two particular trades. In all honesty, if I can understand what a covered call is and what it means to be short a put option and what it means to be long stock, essentially, because that's what a covered call entails as well, I can then understand what the covered combination is and how it sort of works collectively. We're also going to touch on some of the motivations. One major motivation for writing any option, and a covered call, or rather a covered combination, involves writing two options, a call and a put, is to generate income, to bring in some additional income, to increase the yield on shares that you might already own. Also, the idea, and this is sort of where the discipline aspect comes in, is to buy below the market or sell above the current market prices. And we're going to talk about that and sort of how that works. I don't have my crystal ball anymore. I learned a long time ago that my crystal ball doesn't work, and I can't ever tell where the markets are going. But if I did have a crystal ball that worked, I would always want to buy when low and sell when the markets were high. That's the easiest way to make money, right? Buy low and sell high. So this is a trade that can help you implement that type of discipline into your portfolio, and certainly something that I hope you'll find beneficial as we proceed on. We're going to get into some examples of the covered combination. We're also going to do this with covered calls and with put writing. We're going to touch on maximum gains and losses. And again, the important part here, the idea of planning. What am I going to do if? Am I comfortable with this particular scenario or with this particular outcome? Because we talk to a lot of investors on the helpline, and they are always saying, you know what, I bought this option or I sold this option and it didn't go the way that I planned. What can I do to correct this? And my first response to them is normally, unfortunately, it doesn't sound like you had a well-defined exit strategy in mind. Some point to limit your losses or some point to take profits should they become available. That's part of being disciplined, and that's a very important part of options or investing in general. So moving on, let's get into covered combinations, talk a little bit what they are. An example of a covered combination, again, we're going to be long 100 shares of the underlying stock. Now, for investors that typically only trade 100 shares, because we do have a short put on this in a covered combination as well, it's really sort of trading in 200 share increments. So if an investor normally trades in 100 shares and you're now comfortable with 200 shares in the account, it might not be a strategy you would want to consider. 500 shares and you're going to do 5 short calls and short puts, you might be in a 1,000 share position. So sort of understand the incremental impact of this particular trade. Long 100 shares of XYZ, short a call option, which is covered by the long stock. And again, bear with us because we're going to get into covered calls. you're short an XYZ put option. That put option can either be cash secured, and we'll again touch on this when we get into the short put area of the presentation, or it can be naked, and that's going to require margin. So we'll touch on that a little bit as well. Typically, the expiration of the call and the put are the same. We can always modify that depending on our objective, depending on our outlook and our motivation. But for purposes of the covered combination, generally speaking, by definition, the expiration of the short call and the short put are both the same. One nice thing about the covered combination trade is a lot of investors can use it to establish entry points or exit points for an underlying security. Maybe I'm an investor that believes in looking at the fundamental parts of a company, and I look at their earnings, and I look at the price of the stock based on the earnings per share, and there's a particular level that I want to get in or get out of. Maybe that'll help me with my strike price selection. I can also look at things like dividend yields. Maybe if the dividend yield gets high enough or low enough, I can set my strike price increments on this trade in that range. Maybe I'm a technical kind of a person, and I really believe in things like Bollinger Bands or stochastics or candlesticks. And these are types of things that may be based on my analysis given those technical indicators. Again, I can make my strike price selection or maybe my expirations based on those types of parameters. So there's a lot of different ways that you might be able to implement these entry and exit points with the covered combination. And again, when we're talking about the covered combination here, we're going to kind of build on this example throughout, so bear with us here. The stock here is going to be trading at $52. Hopefully nobody ever really goes public with the XYZ ticker symbol, because if we do, we're going to have to go back and modify a lot of information because we always use our theoretical hypothetical stock XYZ. But in this example, a covered combination, we're going to sell the $55 call option covered by the long stock, and we're going to go short the $45 put option. Notice that the call strike is above and the put strike is below the $52 stock price. We're also going to call this trade, you might hear it referred to as a covered strangle. A short strangle specifically consists of a short call and a short put. The short call here, being that in and of itself can be a very risky position, here we're covered by the long stock, reducing the risk considerably, so we refer to this trade also as a covered strangle. And again, because we're selling a call and we're selling a put, we're going to capture two premiums along the way. Again, the investor discipline aspect of the trade, something that I really enjoy talking about in this particular strategy. Buy the underlying below the current market prices. Again, my crystal ball. If the stock was at 52 and I had an opportunity to buy below that, it might be a good investment. You have to be comfortable with the risks associated with that short put assignment, should you get assigned on that put, but it might provide you with an opportunity to buy below the current price. Conversely, the market rallies and it rises up above the call strike. Might be in a situation where you are selling stock at the short call strike price, stock that you already have in the account. So that's from the short call assignment. And much like owning shares or just writing the put in and of itself or writing a covered call, the biggest risk of this trade is in the declining stock price. And maybe even more so here than with the covered call, because remember when I said that you were long 2 units here, essentially because of the short put, that you're really impacted by declining stock price. With the covered call, I'm only limited by the stock. With the covered combination, I'm also exposed on the downside by the short put as well as the long stock. So it's sort of a double hit there should the stock start declining on us. Understanding of covered calls and short puts, as I've already said here, is going to be very imperative. So with that being said, let's proceed on and begin our review of covered call writing. We always have to understand here when we're talking about the call options, that the call holder, the person who buys a call option, has the right to buy shares, the right to buy the underlying security. Conversely, the call writer who sells the call options has an obligation to sell the underlying stock if they're assigned. The call buyer, of course, can exercise. That might result in the call seller on the right being assigned. The call buyer pays a premium for the rights associated with the contract. The call seller, on the other hand, collects the premium and can invest that elsewhere. The call holder, pretty bullish. Main motivation for buying a call, just a straight out long call option, is because you're bullish on the underlying stock. The call writer, however, neutral to bullish. Maybe moderately bullish is what we like to say. So neutral to bullish. That's sort of going to be the theme of the covered combination, neutral to bullish. And note that all these options here, these equity options we're talking about, can be exercised and assigned at any time prior to expiration. Very important concept to understand. And when exercise and assignment activity might occur, we're going to touch on that towards the end of the presentation, so bear with us. Call holders are those that buy to open, and call holders have the right to buy the underlying stock, of course, at that fixed price, at the strike price. And because these are American exercise style options, that can occur anytime. They have the right to exercise that option at any time. Call writers, however, they sell to open options to create a short option position, and a call writer has an obligation, and I was going through this presentation earlier and I came across the word obligation, and I've used that word for quite some time, being my background in the options markets, and I really said, so what exactly does obligation mean? So I pulled it up on my dictionary app on my phone, and this is coming right off of the app, and it says here that it is a binding promise, and I thought that was a very good definition because it's a binding promise. There's no way that I can get out of it unless I elect to close out my call position. As long as I maintain that short call position, I have a binding promise or an obligation to sell the underlying shares, to sell it at the strike price. And again, an assignment can occur any time before or at expiration. So be aware of that and be comfortable with it. In exchange for the short call, in exchange for the premium, the option writer, or in exchange for the obligations, rather, associated with the short call, the option writer, or the person who sells to open the call option, they're going to collect the premium, and they're going to keep that premium. Whether or not you're assigned, doesn't matter. The premium is yours to keep. The short call profit potential has limited upside. And I remember years ago, back in the late 90s, I was engaging in a particular option trade, and I sold a covered call. And I always like to talk about the risks of this particular aspect of it because there's limited upside. And if anybody was around back in the late 90s, they might remember that the markets were on a very, very upward trajectory. It seemed like every day they were going up and up and up. And when I had sold that covered call, I had limited my upside. And I found that to be a very unfavorable outcome because I had foregone a lot of profit potential on that. I knew what I was getting for the shares, and I got some premium along the way, but I might have had 100% return in that stock. So you have to be comfortable with the limited upside potential. And the limited upside potential comes from the strike price and the premium. Add those two together, and that is the maximum value of the collective position at expiration. And again, the loss potential is considerable, substantial. Stocks can go to zero. We don't usually hear too often of stocks declining to zero, but a couple of years ago I was doing a presentation down in Houston, and I remember the folks that were probably in the room that had once maybe worked for a company called Enron. So there are, in fact, securities that can go to zero, then that can happen quickly, so we have to be comfortable with that downside risk when we're writing covered calls. If I'm going to sell a covered call, what is my net sale price for those shares? Again, the strike price of the option plus the premium received. So let's just say, just for the covered call here, this doesn't include the put. We're going to get into that for the covered combination as we progress. But let's say that I sell the $55 XYZ, 55 is a strike. I'm going to bring in $3.60 in premium. Important to note too here, when we're talking about premiums, we know that for the most part in options, that $3.60 premium equates to $360. And of course, as we've already mentioned, we're not including any fees associated with that, but 55 is a strike price. If I'm assigned, I have to sell XYZ at 55, but effectively I'm getting $58.60 per share. I'm getting the 55 strike. I'm getting $55 when I deliver the stock. I already brought in $3.60 in premium, so I'm getting $58.68 total per share. Now understand that those cash flows do come at different times. When I sell the option, for the most part, I get that premium either right away, maybe the next business day. When I'm assigned, I'm not going to get that premium, or rather the strike price proceeds, until I'm assigned. So I might sell a 2-month option, get the $360 today or tomorrow, 2 months before I get the 55. So we have to understand that those cash flows do come at different times. So what is an objective of covered calls? As we've already kind of touched on here, one of the primary objectives is to generate some income. So building on our example here, XYZ is currently trading at $52, and we can see the range here of 44.80 to 58 and change. as with most stocks, XYZ appears to be fluctuating. And it is funny, sometimes I get calls from investors when I'm taking calls on the help desk, and they say, well, what do you think's going to happen to the markets? And this is a case in point here. I like to tell them that, I think the markets are probably going to go up and down over time. And in all honesty, that doesn't sell advertising dollars, but that's probably going to be the truth. And the XYZ appears to be one of those types of candidates that's gone up and down over time. Our forecast here on XYZ, we're neutral to moderately bullish. Again, emphasizing neutral to moderately bullish for the objective of the covered combination, or in this case, just the covered call. I want to generate some income, and I don't mind selling the stock if it rises. I'm comfortable with the limited upside. So what am I going to do here? I'm going to choose that $55 August call. I'm going to go out a couple months in time, capture some additional time premium, and I'm also going to sell one that's, notice that call option is slightly out of the money. Stock is at 52. I've selected the 55. Why would you do the 55? Because you're hoping that the stock rises. You make $3 on the rise from 52 to 55, and you also bring in the $3.60 in premium. So hopefully that was a review for everybody, and everybody's comfortable with the covered call trade. That being said, let's move on to short puts. When I'm a put writer, or when I'm a put buyer, let's start off on the left. When I'm a put buyer, this was hard for me to understand when I first started learning options. Why the right to sell shares? So I'm buying the right to sell. It's kind of a difficult concept to grasp, and I think for me, it really started to click when I thought about, what if I had long stock? What if I was long 100 shares? And I was going to buy that put option. Say the stock was trading at $75 and I buy the $70 put, and suddenly tomorrow the stock starts trading at $25. So now selling it at $70, the right to sell it at $70 sounds like a pretty good thing. So it made it a lot more intuitive for me to think of that protective put, which is not what we're talking about here, but that protective put made it easier for me to understand long put positions. In any event, the put holder does have the right to sell the stock. Sell it to who? Sell it to somebody who's short the option, because somebody who's short the put option has that obligation. That obligation, remember, a binding promise, has that binding promise to buy shares in the event that they're assigned, because somebody that's the holder on the left might exercise, and the seller, therefore, some seller out there would get assigned. An option holder, the person who buys the put, of course, pays the premium, much like with the call here, the short call, the seller is going to receive the premium. The option holder, again, generally bearish, maybe cautiously bullish if it's a protective put, which is what we're not talking about in this example, but generally speaking, a put buyer would be bearish. The the put writer here, again, similar to the covered call, neutral to bullish. And once again, these options are American exercise style options. So exercise and assignment can occur anytime. In fact, I talked to an investor just about an hour ago when I was taking calls on the helpline. And the investor, he was trading in OIC's virtual trading platform, which if you haven't used it, you do have access to it as a OIC customer on the optionseducation.org website. But he had written a put option, and the stock had suddenly declined to his strike price, and he thought that he was going to be assigned. Well, that might not be the case when you're short the put option. You might not be assigned right away. They just reaching the strike price doesn't necessarily mean that the assignment is going to be forthcoming right away. It has a lot to do with time premium and other factors. But we do know that put holders, those who buy to open, have the right to sell at the strike price anytime. A put writer, on the other hand, those are writers who sell to open. Remember this covered call, you sell to open the put option, and they have that obligation to buy the shares, the put stocks. The option holder can put it to the put option writer at the strike price. So the put writer, therefore, has to pay the strike price when they're assigned, and again, can occur any time. In exchange for the obligations of the short put, the writer, again, receives the premium from the sale. That's really the motivation. You're sort of selling insurance here, if you will, when you're writing a put option. You're selling insurance, and you're insuring somebody else's shares. So you're sort of selling the insurance, and if you maybe think of it as maybe somebody has an insurance policy on their automobile, and we don't think much of insuring our automobile, we pay for it, but the insurance company on the other hand is receiving the premium from somebody who is buying the policy to insure their car. And in essence, if you crash your car and total it out, you can put it to the insurance company in exchange for whatever coverage you have, similar to the short put writer. You're sort of the insurance salesperson here. The short put profit potential, limited to the premium received. It's limited. The upside is limited. If we looked at a profit and loss diagram from a covered call and compared that to a short put, you would see that the diagrams are almost identical. In fact, they are identical because you got a lot of downside risk. The risk is substantial on the downside. Remember, stocks can go all the way to zero, but that is limited by the underlying stock, of course, declining only to zero. But the maximum you're going to get is that premium that you received. Now, what about if I am assigned on my put option? What happens? Upon assignment of a put option, my net purchase price here, because I did bring in some premium and I'm paying the strike price when I'm assigned, we're going to take the strike price of the put, simply subtract the premium that I received. That's my net purchase price, what I like to call the effective purchase price. Effectively, you're buying stock at the strike price minus the premium received. So, for example here, and again, only for the short put here, this does not include the cover combination, we're going to sell the $50 put at $3.80, and we know that that's going to bring in $380 before commissions. And we know that that carries an obligation in the event that I'm assigned to buy 100 shares of the underlying at $50. And again, the purchase price is simply going to be 50 minus 380, the strike of 50 minus the premium. Effectively, I'm buying stock at $46.20 a share. Some of the things we want to consider when it comes to the risks of a short put option in and of itself here is very similar to a stockholder. Again, stock prices can decline. That's going to negatively impact a put writer, typically, depending on the effects of time decay and other factors. But if it's a substantial decline, it will more likely than not result in a considerable loss. What about the net price paid for the stock? What if that happens to be less than the current market price? In other words, that $46.20, I think it was, that I paid on the previous slide. What if the stock's trading at 48? Well, the difference is an unrealized profit. What in the other case, the bad case scenario, what happens if the net purchase price is greater, $46.20, and the stock's trading at $10? All of a sudden, being short that put or being assigned on that put doesn't sound like such a good proposition. So you would have an unrealized loss so long as you keep the stock that you ended up being put, provided that you didn't have an exit strategy in mind and elected to close out this put position before that traumatic event took place. Something to consider, a few things to consider when you're writing put options, regardless of whatever your motivation might be. Are you comfortable owning more shares? Do you really want to own the stock? So if you are, maybe entering into a short put is something to look at. What about financially able? There's a lot of differences here. I like this particular bullet point. Are you financially able to buy the stock? What about you? In this example, we were writing the $50 put. So my obligation is $5,000, or if I subtract the premium, the $4,620. But what about now if I move it to say 10 contracts? So now my $5,000, all of a sudden now I'm obligated for $50,000. What if I move that to, say, a $500 strike price on a $500 or plus stock? Now all of a sudden you're talking $50,000. 10 contracts on that, you're talking $500,000. So there can be considerable risks in these types of trades and considerable differences depending on the stock price. So be aware of that. Are you financially able to buy the stock if you're assigned at the strike price? Are you going to pay cash for the stock? Do you have cash in the account, some sort of a cash reserves? Are you going to buy margin on it? Is it in a margin account? Will you be able to borrow against your margin account to pay for those shares in the event that you are assigned? But in any event, be aware that the net stock purchase price could be greater or less than where the stock's currently trading at. We, of course, hopefully we bought it at less than where it's trading at effectively, but it very well could be greater than the net purchase price could be greater too, in which case I might have a loss. So you got to be comfortable with the risks associated with the trade, have those predefined exit points in mind, and stick with them. And moving on with an example of a short put. Again, we got XYZ trading at $52. Same range as we had on XYZ previously, so apparently in the 5 or 10 minutes here, XYZ hasn't changed in price much. And again, we're neutral to moderately bullish. Neutral to moderately bullish. Objective, similar to the calls. We're looking to buy XYZ, or the generate income objective, I should say, is similar to the calls, but where we wanted to sell it on the call side, now we're looking to buy it at $50 or less in 3 months. So what might be a good position to take on? Well, we might look at the XYZ $50 put and trade that for the $3.80 premium that it's bringing in. So hopefully everybody has a good understanding of covered calls, a good understanding of writing put options and what that entails. And all that being said, let's put it all together and talk more about the whole picture here of the covered combinations. As we said at the beginning, you're going to buy, or you might already be long, 100 shares. Could be 500 shares, whatever number you want to plug in there. We might, if we're going to do the covered combination, we're going to sell to open one call option and one put option. Generally speaking, the strike price of the call is going to be greater. Remember, 52 was the stock and 55 was the call strike. It's going to be greater than the current price of the stock. That way we get to take advantage maybe of more time decay. The short put strike is going to be below the price of the stock. Remember the $52 stock, and I think we sold the $50 put. And again, our forecast, similar to the other two types of trades that we've mentioned, were neutral to moderately bullish. We might also want to point out, because we are doing 3 trades here, this can potentially be a commission-intensive trade. I got to buy stock and I'm selling 2 options. To unwind it, I got to pay 3 more commissions. So check with your firm on how they're going to charge you for that, but be aware that we're starting to build on more commissions here as we're building onto the trade. Putting it all together here again with the covered combinations, maybe I'm looking to buy shares below the current market price. Again, my crystal ball says buy low. So maybe I want to buy it below 52 if I can, or I'm comfortable selling it should it rally. And if neither of those two events take place, I get to generate some income. And maybe that's an objective that I have, is just to generate some income. Maybe I'm neutral. I think the stock's just going to stay in a range, and I'm just going to capture some premium along the way. In order to generate the income and keep all the premium, we get to keep premium in any event, but to avoid the assignments, we have to have the stock price expire between the call and the put strike at expiration. We have to be willing to buy additional shares, as we've already said, and to sell shares. Sell the shares here that are already in the account, because remember, this is a covered position. The put assignment would result in the purchase of additional shares, the call assignment and the sale of shares. And we got to be comfortable here. Remember how we said that not only is it impacted by the declining stock price, but the declining stock price is also going to have a negative impact on that short put, because understand that the put premium is going to increase, which is a bad thing for the person who is short the put option. Or at least if you're looking to close it out. Maybe you're comfortable owning more stock and you don't mind that outcome, but be aware of that potential risk. So we have to post the full cash amount, unless we're going to be using margin. We do have to come up with the cash to buy the additional shares, or we maybe borrow against our margin account to do that. We're looking to generate some income. We want the call and put option to expire worthless. Excuse me. The option writers are always content to receive and keep the premium. That's why an investor, for the most part, would elect to write an option to capture that premium and to reduce some exposure potentially. Then in this case, the writer has to be willing to either buy or sell stock because of the call and the potential for the call or put assignment. If I'm assigned on the call side, what about my net sales price, my effective sales price? If I'm assigned, remember, because I got 2 premiums, I got the call premium and the put premium, so now I'm going to add those collective premiums to the call strike price. That's my net stock sales price, because I'm being called away at the strike price plus my call premium and put premium. I'm going to give up the 100 shares that are in my account. I have no longer any stock remaining, of course. If I only had 100 shares, that stock is now gone. I've been called away. And I still have the short put. So, that might be a situation, again, where some advanced planning comes into play. What if I'm assigned early on my call option and I still have the short put? Do I then close out that, or do I try to capture all that premium? If stock pulls back, what happens if sort of scenario? So sort of think through some of these if you're thinking about entering into this particular trade. The call assignment here, now we did lower the put strike. The previous example, we did the 50 put. So here we're going to lower it down a little bit because we are collecting 2 premiums. So we're going to sell the 55 call and the 45 put. And when we do that, we're going to bring in 2 premiums, as we've already said. Collectively, that's going to total $5.55. I'm getting $5.55. That's simply $3.60 plus $1.95. Total premium received. My sales price for the shares, if I'm assigned on the 55 call, is simply the 55 strike price plus the $5.55 in premium, total premium that I brought in, effectively selling the stock on my call assignment at $60.55 a share. Now that's a good outcome, maybe not too bad. Sounds like that was a profitable trade. What about the put assignment? What happens if I'm assigned on my put option? Well, remember that I didn't mind owning shares on a pullback, so hopefully I'm comfortable with that. But upon assignment of the put option, my net purchase price for the shares that I'm being put, because I'm buying stock here from the put assignment, I'm short the put, obligated to buy stock. I'm buying stock at the strike price, but I brought in 2 premiums. So again, I'm going to take that collective premium and I'm going to subtract it from the strike price of the put option. That becomes my net stock purchase price. Now I end up with 200 shares. My 100 shares that I had originally that were covered by the call, and now I've got 200 shares. Short call remains open. It's still a covered call, provided that this put assignment rather occurs early before expiration. But I do have my short call that is a covered call still. And of course, again, we don't include any commissions here. So building on our example here, same stock. We did the 55 calls just like before, $3.60 and $1.95. The strike price was $45 on the put. We're adding the 2 premiums, $5.55 in total premium, and we're simply going to subtract that from the 45 put strike. So my net purchase price becomes $39.45 per share for those extra 100 shares that I bought. Now I do have 200 shares of XYZ. So $39.45 for the extra 100 shares that I bought. But what about my collective position? What if I originally bought the stock here at the $52? I bought my original shares at $52. So how does that impact the cost of the collective now 200 share position after the assignment of my put? Well, the total premium, again, the $5.55 remains. So I get another shares buying them at $45. So to figure out the combined, sort of the average purchase price, if you will, for the 200 shares, I bought them at $45, not including any premiums yet, 45 strike plus 52. Add those 2 together, now take out the $5.55 in premium. That gets you to $91.45. Simply divide that by 200, and it comes out to about $45.73 per share. So my effective purchase price for the total 200 share position becomes $45 and change. Some things to be considered with when we're talking here about the covered combinations. Again, are you comfortable selling stock? Are you comfortable selling the underlying stock? Because you have to be. You call assignment. Those foregone upside profits that I talked about. Are you foregone? What if it's $52 stock? What if it's some sort of biotechnology stock, and tomorrow it comes out that they have found a cure for cancer, and the stock goes from 52 to 200. You're down here selling it at $60.55 or whatever number that was. Are you comfortable with that? You forego a lot of profit potential. So if you are comfortable with that, then maybe this trade will work out for you. Are you comfortable buying more shares? Remember the short put. I'm carrying the risk of short put. So, being assigned on that put option, I have to buy more shares. Again, will I pay will I pay cash? Am I going to borrow against my margin account to do that? These are things you want to talk over with your brokerage firm. Are you financially able to purchase a stock? The purchase price of the shares that you got, as we said previously, that could be less or more than the current market price of the shares. It depends on the put strike and how much premium you brought in for the trade. What are some of the other risks of the covered combination? Well, as we've already mentioned, the biggest risk is the declining stock price. The declining stock price, because you get losses here from both the put, the short put, and the long stock. So it's sort of a double whammy if the stock starts to decline. Be comfortable with the stock pulling back, because that is the biggest risk of this trade. Somebody might call up and say, I'm thinking about doing a covered combination on XYZ, but I'm pretty bearish on that particular stock. So I'm thinking about doing this, getting a couple premiums. Well, as we said, neutral to bullish. You're telling me that you're bearish on the stock, but you're talking about a trade that says you're neutral to bullish. So to me, that doesn't make much sense. But in any event, understand what you're getting into, understand what your forecast is, and invest in these different strategies accordingly. Losses are limited but substantial. We always like to use they're limited, again, because the stock can only go to zero. But they are substantial, because remember that $500 stock, $500 put strike, for example, If that stock was to suddenly decline considerably in value, it can be out a lot of money, so substantial losses. We always have to include our profit, don't have to, but we like to include our profit and loss diagrams because this gives us a visual representation of how a trade might look. The stock price here is going to be on the x-axis, so from left to right is where the stock price is going from lower to higher, and our profits are on the y-axis or the vertical axis. We can see that our profits are limited. The line straightens out there as we move from left to right at the collective premiums plus that call strike price. The downside, however, is very substantial. We can lose a lot here because the stock price is declining and we're long stock, but we also have the put option to be concerned with. The cover combination, again, various objectives potentially here. Maybe I want to buy more stock, pulls back. I want to sell it if it rises. I want to capture some premium along the way. So again, XYZ here, similar to where we've been before, the forecast neutral, moderately bullish. So to do the cover combination, I'm going to do the short put at 45. I'm going to short the 55 call. I'm going to capture 2 premiums. I'm also going to own stock here. I'm buying it at 55. Somebody might say, well, why did you choose the August options? Why not the July options? Or why not go out to maybe there's October's out there, whatever other month might be out there, or other strike prices? Well, you have to sort of look at it. Ideally, an investor would evaluate the different choices that you have. Look at the put strikes and the premiums. Is 45 minus whatever that was, 39 in change, our entry point, was that acceptable? If not, then maybe move on to a different strike or move out in time to capture some additional premium. My exit point, those collective premiums, was that $60.55, is that acceptable? So sort of look through that. Look at the different expirations that are available. Look at the different premiums. Sort of find that sweet spot. What one's going to work best for you? And find that and invest accordingly. So at expiration, what happens? Well, stock here, we're so far worked out pretty good because in this example, the stock has actually increased in price. So that's a good thing for us. What we do know is at expiration, above 55, the $45 put is almost certainly going to expire worthless. Nobody's going to want to deliver stock to us at 45 when it's trading well above 55. And our call option is going to be assigned. So we're going to deliver shares at 55. We, of course, get to keep the premiums from both the call and the put. And our selling price here effectively is the $1.95 plus the $3.60, the call and put premiums, and the $55 call strike price. Those are my positive. I'm bringing in cash flow on all 3 of those. So effectively, I'm selling stock here at $60.55. That, therefore, becomes my maximum profit potential. The maximum I'm going to make, should the stock go well above 60.55, I'm not going to make any more money. That's my cap right there. That's where that horizontal line back on the slide on the profit and loss diagram, that's where that one came into play. So let's just go back to that right quick here, and we can see here that up there where that line becomes horizontal from left to right, that is where the trade is at 60.55 in this example. That's that $5.55. That's your maximum profit. But we do end up with no shares of XYZ in the end because our shares were called away because of the call assignment, and everything is now expired. Now, what happens if the stock declines below 45? Well, conversely, the call is now worthless, probably going to get assigned on our put option. We're going to be long not only the 100 shares we already have, but now an additional 100 shares. We've got to pay the $45 in premium. And remember, our net purchase price for the additional 100 shares becomes $39.45. Simply the put strike, subtract the 2 collective premiums. Our average price for the whole position becomes what we paid for it collectively divided by the 200 shares. So we're at about $45.72 like we said before. And of course, if the stock declines by more than $5.55 from the original $52 price, that's where we're going to start to incur losses. So are we comfortable owning stock? Should it pull back? What happens if the stock is between 45 and 55, our strike price selection here? What happens if we're between? Well, our obligations to buy and sell the stock expire. Everything is going to expire worthless. We're going to keep the call premiums and the put premiums, and on that expiration and a little bit there, we're going to get a little bit more into that here in a couple slides, so bear with us. We're going to keep the call and put premiums. We're going to incur losses if the stock does decline by more than $5.55, like we said. So $46.45 becomes our downside break-even price. Should the stock decline below that price, we're going to incur losses. Above $46.45, however, trade works out all right for us. Our maximum gain. What about our maximum gain? Well, remember when we sold the call option, we said that you got from 52 to 55, that you got that. You got $3 in gain, but here you've also brought in 2 premiums. So collectively, our maximum profit is the $3 from 52 to 55 plus our 2 premiums for a total of $8.55, again, before commissions. Gains are limited from the stock and from the premiums, limited upside potential. Again, neutral to moderately bullish. So it goes up a little bit, we're okay with that. Goes down a little bit, we might be okay with that too. Now what about the loss? What about our loss potential? Well, we got XYZ again, 52, so our maximum loss is the stock purchase price, 52, plus our put strike, so 52 plus 45, minus the premium we brought in. So in the event that the stock does really sell off and tank way down, we could be at a total of $91.45 per share, but because it's a 200 share position now, it's a total of $9,145. So losses can occur on both the stock and the put. Again, if you're bearish, this trade probably isn't the one to look at. And these losses only occur in the event, the maximum losses only occur should XYZ be at 0 come expiration. The importance of planning, we touched on that. What is, what are we going to do if? Well, what should we do if the stock price is above the call strike when expiration is approaching? Well, we can make the assumption that we're probably going to get called away. Are we comfortable with that assignment? Maybe we are now more bullish on the stock than what we were back in June. We're now in August, back in June when we sold the call option. So maybe I'm going to take on maybe I decide to buy back the call option and unwind my obligations. I could do nothing, wait for the call to be assigned, and wait for the put to expire. We have to be concerned about this and always have that plan in mind when you establish your position. What are you going to do if? What about if it's between the 2 strike prices? Well, we might buy to close the call or put if it's close to the strike, so maybe it's at, we said the 55 call, so maybe it's at 54 and change, or the 45 put, so maybe it's close to 45, maybe 45 and a half. Maybe I elect to buy back one or the other to be absolutely certain of avoiding an assignment, because we know that the only way to be 100% sure to avoid an assignment is to buy back the call option or the put option. And I've talked to many of investors who didn't understand that. They would establish a position. I've talked to investors who were both assigned on slightly out of the money options and those who were not assigned on slightly in the money options. Doesn't happen very often, but they didn't make certain that they could avoid assignment by closing out their position. So if we want to be absolutely certain of avoiding an assignment, we may be able to close these out if it's close to expiration for nickels or dimes. Maybe that's something worth considering. Or maybe if it's between them, we just let everything go and hope that everything expires worthless. In any event, there's no objective answer. Every investor has to make this decision on their own, giving their risk parameters for their portfolio, their investment objectives, their desire to take on risk. There's no objective answer here, so everybody has to kind of look at this independently. Maybe this is something you talk about your financial advisor with. What about if the stock tanks on us? What if it's below the put strike price? Well, maybe I consider looking at rolling the option. When we're talking about rolling, we mean moving maybe out in time. I might roll out from August to September, or I might move out down or up in strike. And here we've said, well, maybe a lower strike. Stock's right around 45. Maybe I go down to the $40. I buy back to 45, and I sell to open the 40. Maybe I keep the short put open, and I just accept the assignment if it comes. I just flat out buy back the short put. I decided I don't want to own stock now, so maybe I buy it back. Reassess my outlook. Refer back to my indicators. Where was I at? Am I comfortable buying or selling stock? So where am I? Am I still bullish? And maybe you accept the assignment and move on. In any event, have these predetermined stop-loss points. Understand where you're going to limit your losses. Everybody has to look at this individually and make up their own mind, but have those, and more importantly, is to stick to those. We talk to so many investors that don't take the time to stick to their outlook or stick to their exit plan. I had an exit plan in mind, but I deterred from it as expiration approached. Stick to your investment plan. Understand the psychological aspects of investing. One of the bigger, I mentioned the virtual trading on the OIC's website. There's a lot of differences between virtual trading and real trading, of course, but to me the biggest difference is the psychological aspect of not having real money at risk. There's no money at risk, there's no harm, no foul. Gets to the real world a lot different. So understand what the risks is and those stop-loss points and stick to them. In conclusion, I'd like to again say thanks to everybody for being here today. The covered combination when we're writing options includes calls and puts. We're looking to gather some premium. Most importantly, understand the risk. What's the risk? What if the stock moves considerably higher? What if it moves considerably lower? When am I going to get assigned? Is there a dividend forthcoming? Maybe the stock's moved higher and somebody that's long the option wants to capture the dividend, so they exercise their call option and I'm assigned and I don't get the dividend. Am I comfortable with that outcome? Understand the psychological aspects of investing and be disciplined. This is a trade that can help you be disciplined, so understand that discipline and stick with it. The follow-up plan is very important. And lastly, let's talk about early assignment. It's always possible. We said these are American exercise style options. So what's the likely outcome? It might be taxable. Is this a taxable account? Do I have a big gain in the stock? Maybe that's something that I want to consider. So I like to maybe close out my call to help avoid the taxable event that might occur on that. Understand when an assignment occurs and when it might be likely to happen. Is the option in the money? If it's not in the money, odds are it won't be assigned. Not guaranteed, but it might not be assigned, especially if it's far away. If it's a $55 call and the stock's at 52, probably not going to be assigned on that. Probably wouldn't hurt your feelings if you were, but you're probably not going to be. If the option is in the money, how much time premium is remaining? So if it's a $55 call and the stock is at $60 and that option is trading at $5, there's no time premium in that option. It's in the money by $5. It's trading at $5. Conversely, what if it's trading at $6 in the same scenario? It's got $1 of time premium. Probably not a very likely exercise or assignment candidate. Early put assignments, generally speaking, are more likely than calls. Some investors don't understand that and might ask why. When I exercise a put option, I get paid the strike price. I can take that money and go and invest it elsewhere. So therefore, I might exercise my put early so that I can invest in other things. Whereas a call option, we don't oftentimes think of long calls, that is, as being an insurance policy, but they kind of insure my cash. If the investor has the right to buy the stock at 55 from somebody who's short the call option, they can keep their $5,500 in the bank and make up their mind at expiration if they want to exercise. So you might use a call position to insure cash, so therefore early put assignments are generally speaking more likely than early call assignments. Remember the dividends just before an ex-dividend date for a call option, so that I can, if I'm long the call, I can exercise today and capture the dividend that's going ex tomorrow. And the other way around for put options. If I'm long a put option, I'm going to keep the stock and the put until tomorrow so that I can own the stock on the X date and then exercise my put. So just after the ex-dividend date for puts are when we find assignments are more likely. So once again, thanks everybody for being here. Hopefully you learned something today. We look forward to hearing from you here on the 888 options line. Send us an email, give us a call, and with any luck, everybody's still awake out there, and hopefully Nick is as well. And hopefully we got some good questions. Nick, are you there?
Very much still here, Darren. Thanks so much for your expertise today. I think we got a really sophisticated investing crowd with us today. We're getting some really, really good questions. A number of the ones that we're receiving are about the really practical matters in terms of accounting for premiums. And I know we can't speak to this in any very specific terms, but can you go into some detail? One of the questions that we responded here was, can you explain the typical accounting of short option premium received and how premiums affect an account's daily profit and loss? And like I said, we might not be able to go into too much detail, but could you speak to that at all?
Yes, absolutely, Doug. Thanks. And that is a very good question. That is something that when investors first establish short positions in their accounts, I talked to a guy earlier today, I think, that had a short position in his account, and he didn't understand how it was being accounted for. What happens is when we sell something that we don't own, which is what we're doing when we write a call or when we write a put option, it's really a debit, the accounting aspect of it. An accountant might look at it as debits and credits. Well, the debit to the account is the position. There's no position in the account, so you now become -1 call option or -1 put option. Or in the case of the comfort combination, -1 call and -1 put. So you're negative the option shows up as a negative in the account, or if it was a short stock, it would be similar. The premium, however, remember there's a debit and a credit so that everything equals out in the end. So the premium, however, is the credit to the account. The credit is the fixed aspect of the trade. If I sell an option for $3.50, I'm getting, that's fixed. That doesn't change. The order has been completed and that credit hits my account. What does change, however, is the price of the option over time. Stock price changes, expiration changes, premiums change. Because I'm short that position in the account, that $3.50 premium might go up to, for example, $5. Well, remember, I received a positive $3.50 when I sold the option. That was my credit, was $3.50. But I'm negative now the option, which is worth $5. So a negative 5 plus $3.50 credit means I've lost, excuse me, I've lost $1.50 on that trade per share. Conversely, if the trade works out maybe in your favor, some time erodes, and the premium, say, goes down to $2. Well, remember, I received a positive $3.50. That was fixed, but the negative short option position in my account is now showing as a negative. So a negative $2 plus the $3.50, that means that I've made $1.50 on that particular trade. So that's a very common thing, and I think that's, again, where the virtual trading can kind of help investors understand that. But yeah, it's sort of a confusing aspect of it. It's sort of a debit and credit. And it's like when you buy a stock. We don't often think of it that way, but I buy a stock. I, of course, pay. Say I buy 100 shares at $50. I pay $5,000. Well, that's a debit. That's a negative. What's the credit? The credit is the positive stock position coming into my account. And obviously, the $5,000 is a fixed debit. The 100 shares fluctuates in value, and that's where I make or lose money. So good question. What other ones do we have, Nick?
Well, as I mentioned, we did have a sophisticated audience today. A few of the people asked about the Greek specifically. One of the questions we got was, should they be using deltas when they're looking at choosing strike prices?
Well, that's a good question. You know, we could have probably spent another hour or two or more maybe if we would have built some Greek information into the trade. That sort of depends. Remember that this particular trade, because we're long stock, so that's a positive delta. We're short a put, which is also a positive delta, and we're short a call, so that's going to be a negative delta. So we're negative the delta on the call and positive delta on the stock and positive delta on the put. Now, puts do have negative deltas, but because I'm short the put, a negative put, like we said, it's negative in the account, times the negative delta is a positive number. So there I'm positive on a short put and I'm positive on a stock. So the cover combination net is a positive delta. You want the stock to move higher. That's where you're going to make money in the trade. But again, maybe you're doing it because you're looking for the stock. You want to buy some more shares on a pullback, other things that we've talked about. But you can certainly use delta. I wouldn't use it as an ends to all mean. Delta, I always like to emphasize, is a rough estimate of how option premiums might perform. Because things like time, which is eroding constantly, of course, and stock prices, those are always changing, and those will impact delta. So, but you could use delta and understand that delta might be a measure of the risk you're taking on. The more positive your delta, the more risk you're taking, because it works okay on the upside, but it's going to work bad on the downside. So you could use that, but I would not use it as an ends to all mean. I might use another way to sort of define my strike prices and my entry and exit points.
Another one of the questions we had was very practical. This attendee wanted to know if this is a highly used option strategy. Do you see the covered combo being used a lot more as compared to, say, a vertical spread? Well, you know, that's another good question. And you know, I'm not a big believer in what's popular and what everybody else is doing. And do a lot of people do that? Do a lot of people do this? Because it doesn't really matter what other people do because everybody's got a different tolerance for risks. Or for risk. You know, an investor that's fresh out of college has got his whole lifetime ahead of him, just starting to generate some income, might have a greater tolerance for risk and a less need for income than somebody who's of retirement age that doesn't want to take on as much risk and isn't willing to incur as much losses. So I'm not a real big believer in saying, you know, well, yeah, it's a very commonly used trade. We do hear from investors from time to time to use it, but that doesn't really mean that it's you know, you got to understand the risks of the trade. As opposed to whether or not it's a good trade to use. So, you know, and when OCC gets trade information, you know, we don't look at it as a covered call. We look at it as a long, you know, a buy to open and a sell to open or whatever information we get from the exchanges. So it's really hard to sort of say is it a commonly used trade because really just you'd have to survey audiences and that sort of stuff to find out. But in any event, you know, don't worry about what others are doing. Understand the risk of your trade. Is it something that's going to work for your investment objectives and invest accordingly? Darren, do both the call that you're selling and the put that you're selling have the same expiration date?
Well, in our examples, yes, Nick, they did, and that is again a very good question, and that's what I think I mentioned earlier in one of the slides. That look at the different ones that are available. Maybe you don't mind selling that 6-month put and selling that 1-month call. Another month goes by and you sell another 1-month call because that one's eroded or it hasn't worked in your favor. There's advantages and disadvantages to all of those. The cover combination, generally speaking, by definition, the expirations are, when somebody says they're thinking about doing a cover combination, I think the expirations are the same. When I talk to somebody on the helpline, an investor, I would always ask them, are the expirations the same? But you can look and sort of tailor it to your risk reward. Maybe maybe you're near term, maybe you're banking it on some sort of a near term earnings announcement. So therefore, the put premium looks more attractive, and you sell that near term option, where the longer term you don't mind selling. You don't want to really sell the stock for a while, so you sell the long term option. So you can kind of mix it and match it. But by definition, a coverage triangle, cover combination, the expirations are the same. But by all means, evaluate the different choices that you have.
Thanks, Darren. And unfortunately, ladies and gentlemen, we are close to the end of our time, as we have time for one last question here. And that question that I saw more than a few times is, it's very practical, Darren, so I don't know if you can give a very specific answer to this, but what price should the put strike be in relation to the long and the short call strike prices?
What relation should the put strike be? Well, we don't have a long call strike. You said long and short call strikes. We don't have a long strike here. We're only short options. We're long stock. But as in the examples, generally, because remember, it's a neutral to moderately bullish trade. A neutral outlook means I just want to own the stock and generate some income. So that sort of implies slightly out of the money options, which is why I built these examples using a 45 put and a 55 call when the stock was at 52 between them. So I could narrow those down and capture more premium. I could widen them out and buy the stock essentially lower but not get as much premium, or sell it higher but again not get as much premium. But again, that's one of the unique aspects of this particular trade. It allows you to customize that aspect of the trade. How bullish are you? Neutral to moderately bullish with the covered call side of the trade. Specifically, moderately bullish means 52 to 55. I think stocks can go up a little bit. Again, if I think stocks going to double, this might not be the best trade. Maybe I'm a little more bullish, so instead of doing the 55, I do the 60. Maybe I don't like the premium of the 60, so then I move out a month or two. Or maybe I like the 65 better because I think it's going to go up a little bit higher. So that's sort of my exit point. The disadvantage of the higher in strike I go, the less premium I'm getting. So then I might have to change my expiration if that's something I'm looking at to capture additional premium. But again, a very good question. Generally the call strike is above and the put strike is below. The biggest advantage of writing options is capturing time premium. Both of those options, the 45 put here and the 55 call, are 100% time premium. So I'm taking full advantage of time decay by selling those out of the money options. Another good question. Appreciate that, Nick.
Darren, we've come to the end of our questions, and did you have any closing remarks for our attendees today? I know when we were talking before the session started, you looked at assignment as one of the very important properties of this strategy. So did you have anything you'd like to say about that, or in closing to our attendees?
Well, just understand the assignment risk. Understand that because you are short two options here, whether maybe even you're just thinking of doing the put side of it or just doing the call side of it, you have to be comfortable with that assignment. Understand, go back to that slide a couple slides ago, where is that assignment risk likely to occur? Understand that those in-the-money options, when there's little time premium left, when dividends have just happened or are going to happen in the case of the call option, that might trigger an assignment. So understand when those types of things are going to occur. Remember, I think I said you could buy those options back for maybe little or no premium. You can buy them back for nickels or dimes. So maybe if you're between the two strikes in this trade, you just buy them back. So you don't have to worry about it. Maybe the last hour on expiration Friday, the stock here is at $50. Well, maybe the last hour you say, you look at it and, oh, it looks like I'm going to go home okay here. And so you leave it only to find out that the last few minutes of the trading day on expiration Friday, the stock rallies up to 55.5. And all of a sudden you're assigned and you weren't expecting it. And is that something you're comfortable with that outcome? So investors oftentimes try to get greedy and capture 100% of the premium, and then they're not comfortable with the outcome of the trade at the end because the assignment occurred and they weren't expecting it. So understand, to be 100% certain of avoiding the assignment, you have to buy back those options. and understand, your comfort level. If you're going to keep them open, what's your comfort level with handling the assignment?
Darren, thank you so much for your expertise and time this afternoon. And ladies and gentlemen, thanks to you for attending as well. While we weren't able to get to all of your questions, we do have our Investor Services desk ready to help. And remember, Darren is a member of that Investor Services team, and you can reach them at 1-888-OPTIONS. They're available during most business hours to answer your options questions, so feel free to reach out to them. We'll be holding our next webinar on June 24th, which will be on the topic of position adjustments. So check optionseducation.org or keep an eye on your email for a sign-up link. Additionally, we'll be doing a second part of our coverage on position adjustments, and we'll be holding that on July 8th. On July 29th, another member of our Investor Services team will be taking us through a session on historical and implied volatility. Again, please check optionseducation.org for the sign-up links. As a reminder, these webinars are archived for later viewing on the OIC YouTube channel. They'll be up there within the week or so, and they'll be available on demand through On24, and those are usually available within 24 hours of the session. Ladies and gentlemen, thank you so much for your time this afternoon, and we hope to see you again next time for our June 24th webinar.